Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Defiant Silver.
The West imposed steep financial sanctions on Russia after the Ukraine conflict, but Matthew Piepenburg warns that those financial sanctions may have a blowback. Matthew is principal at Matterhorn. Matthew, so good to have you on Kitco.
Nice to be here. Thank you. Yeah.
The conflict is now almost 3 months old right now. Talk about the concerns about the financial sanctions that were imposed.
Yeah, our colleague and advisor, Grant Williams, said a few weeks ago, I think he was absolutely correct. He said in some ways, February of 2022 was as important a watershed moment in global markets as August of 1971 when we closed the gold window. And I think notwithstanding our obvious concerns about war, civilian deaths, violence, using military solutions in any kind of political scenario. Aside from that, without taking a pro-Westerly stance, I think the financial sanctions have backfired dramatically for Western nations and Western economy in general, and the US dollar in particular. And by that I mean taking the Russians off or freezing FX reserves, taking them off SDR access, or taking them off the SWIFT payment systems, really isolated Russia. And that was good headlines, good chest puffing, good kind of political virtue signaling for an invasion that I think ultimately could have been avoided. But notwithstanding that, when you weaponize the US dollar in that way, that genie can't be put back in the bottle. And by that I mean, of course, I can understand the political headline appeal of sanctions against Putin and the big bad bully that he is. It's a misunderstood kind of bilateral view of things. But notwithstanding that, other countries, friendly or less friendly to the US, have watched how the US and the West in general can weaponize the dollar in a way to freeze your assets. I joke that if I had an account at Wells Fargo or Goldman Sachs and they freeze my assets, I probably wouldn't recommend that bank to friends or want to use it in the future. It's a simplification, but in a lot of ways, the reaction by other countries has been eyebrows raised, looking back and thinking, that genie can't be put in the bottle. What if we do something that makes them freeze our assets? Or what if we don't have SWIFT access? Or what if we can't get FDR access? And so that's a consequence that just brings kind of the neutrality of the US dollar out of its neutral space and now looks like a more biased currency. That's the first reaction. The other reaction, obviously, is now Russia is forced to get closer with China, which they've already been kind of doing with trade policies. And from over 10 years, they've signaled a desire to kind of go from a one-polar or monopolar currency to a multipolar currency. More currencies and exchanges being in place than just the US dollar or the SWIFT accounts. And this gave Russia and China the excuse they've been looking for to think outside of the US dollar. And you're seeing that already when China is in negotiation with Arab states, and the Arab states are in negotiations with China, India, and other countries to even consider purchasing oil outside of the US dollar. That's a slow, not an overnight process towards a de-dollarization of the petrodollar, which is extremely important in global finance, because it's no coincidence that when Nixon dropped the gold's backing in 71, within 5 years we had a petro backing, a petrodollar. Oil had to be purchased US dollars. So in some ways we lost the chaperone of gold and acquired the chaperone of oil. These sanctions have disrupted that system. So trust in the dollar as a neutral currency is eroding. The petrodollar is slowly eroding. The relationship between China and Russia is only strengthening. Despite the headlines and the political frustrations of violence or war, that's a financial turning point. It's a watershed turning point. And I think that can't be undone. Even if there's peace tomorrow in Ukraine, I think the memory of what happened in February is going to be hard to undo. And I think this is just the first or second or third chapter in a much larger book of the dollar slowly losing its hegemony in global markets.
What will be lost if the US dollar does lose its hegemony? What will they suddenly see that they don't have? Which disadvantage would they realize that they had before?
Well, in a lot of ways, I mean, it can be good and bad. In some ways, I think it won't be orderly, for one thing. With the US dollar as the world reserve currency, the US has been able to kind of export its inflation for decades. As the central bank in the US prints money to monetize its debt, then other countries in third world or developing countries who owe debt in US dollars have to do the same. They have to debase their currencies as well to pay back their US dollar denominated debt. So what happens at the Eccles building in DC has massive ramifications in South America or Eastern Europe or Asia, because these less developed economies, from Turkey to Argentina to Venezuela to elsewhere, they have a lot of dollar-denominated debt. And so if the dollar loses some of its hegemony or some of its eminence or some of its perceived neutrality, There are going to be other countries that are going to look towards trade in non-dollar denominated trade. So that, of course, affects the value and not just the reputation, but the power of the US dollar, which will no longer be just the provenance of the Fed to control with rate hikes to make the dollar more appealing. So again, not overnight. It's a slow process. The dollar has lost a lot of its credibility since 1971. The petrodollar accord with Saudi helped bring some of that eminence back. But decades of exporting inflation, decades of mismanaged kind of, I think, reckless driving or drunk driving at central banks by expanding the broad money supply. All these things are converging to make other countries, certainly less friendly countries, the U.S., rethink and refocus a different future that's outside of just the U.S. dollar, from SWIFT accounts, SDR to trade. So again, it's a turning point at the very least.
Can you conceptualize what might be being built with an alternative with Russia? How could that actually come together?
Well, we're even seeing it now. I mean, when you see, basically these so many kind of ironic scenarios happening from Germany and Austria and Western Europe with their trade with Putin. In some ways, it's the irony of seeing Olaf Scholz, who's the chancellor in Germany, having to openly on the headlines criticize Putin's foreign policy and actions in the Ukraine, and even sending some versions of weapons to Zelensky or the Ukraine, but at the same time, he's having to send dollars or rubles to Putin. In other words, Germany is financing Putin at the same time they're giving weapons to Ukraine. It's kind of a bipolarity, a schizophrenia, but it's forced realpolitik. Yeah, I think 35% of German oil and 45% of its gas comes through the Ukraine. So they can't afford to be too tough. It's the same thing in Austria. 80% of their oil comes through the Ukraine. So they may have moral or political reasons to criticize Putin, but they're stuck in the realpolitik of being completely dependent on the natural resources that come out of Russia and through the Ukraine. So it creates this real confusion. And I think ultimately what's going to be happening, if Putin can ask for rubles, for gas, or even gold in certain cases, and if China and other countries can go to Arab nations and ask for some oil without having to pay in dollars, those are slow but significant changes in how countries do bilateral agreements rather than just follow the US dollar's lead through trade and through monetary and fiscal policies in the future. So again, I think it's this long hegemony since 71 of a mismanaged dollar that bought us lots of great time, lots of inflation that we went into risk assets or we could export to foreign countries. I think the rooster or the chicken's coming home to roost on the US dollar. And I don't mean that in a gloom and doom dramatic way. It's the end of the world reserve currency or it's the end of the US dollar, but it's a slow but real turning point away from something that I think is inevitable over the next 10 years.
Matthew, I think you'll have some opinions about hard assets, particularly about gold, but I just want to talk just about crypto and what we saw the actions with Bitcoin. It seems like Bitcoin kind of broke down a bit over the last couple of weeks.
Yeah, look, obviously everyone's going to think I have a pro-gold bias. I clearly have a bias towards precious metals. And usually the debate is Bitcoin or gold versus Bitcoin. Ultimately, I think they're two very different athletes on two very different playing fields. With what we saw on the NASDAQ in April, for example, that was the worst month and that was the worst market move by the NASDAQ since 2008. That was brutal. April was the cruelest month for the NASDAQ, but it was also a cruel month for Bitcoin. And to me, that's no coincidence. And this will upset a lot of true believers in Bitcoin, and I understand that. I wasn't surprised because in my mind, at a higher multiple, the Bitcoin in cryptos in general, and the Bitcoin in particular, follows or tracks the NASDAQ. Because in my mind, Bitcoin is ultimately a tech stock. People say it's an alternative currency. It's a store of value. There's that its time will come. It's consolidating right now. It's emerging outside of this crypto universe, and that Bitcoin will one day get the last laugh. It's possible. It's true. I know a lot of good people who believe in gold and Bitcoin. I'm not trying to promote gold by making fun of Bitcoin, but my personal opinion, and it's just an opinion, and it's shared by some and not by others, is that Bitcoin, for a number of reasons, will not emerge as a store of value or as an alternative currency. There's a great group over at Monetary Metals, Keith Weiner, who's written about this better than I can explain it. But at the end of the day, I think Bitcoin will track the NASDAQ as a tech stock. I think the blockchain technology that makes it so attractive will be used, but not as a world reserve currency or as an alternative currency. It'll probably be used by the IMF and central banks down the road, the technology. But the coin itself will either be legislatively kicked away or it will be like any pyramid scheme. Eventually there'll be the final buyer and there'll be a lot of sell-offs after that. Again, Saylor and others would consider that absolute gold bias or prejudice. I think Bitcoin was one of the greatest risk assets, speculation assets you could have bought. I wish I'd bought more, because the truth is I made a decent amount of money by accident in IPOs in the late 90s during the dot-com bubble, and they had no cash flows, profits, or earnings, but they made a lot of money for a short time. I knew then it was a lottery ticket. You can't compare an IPO or a pre-IPO in the dot-com bubble to Bitcoin. There's differences, but at the same time, there are a lot of similarities. And I've kind of seen this movie before. Again, blasphemy to Bitcoin holders. They're going to think that's just a pro-gold bias, but I would not trust Bitcoin as a store of value or as a currency hedge like I would physical gold. And look, for those who've made money in Bitcoin, I'm not envious. I am envious, but I'm not against it. We see a lot of clients coming to Zurich, though, who've made millions in Bitcoin who want to convert that to gold. And there's a reason, because they know what it is. It's a trade. Everyone I know who's done very well in Bitcoin has confessed that it's a trade. I was just talking to a family office in the US the other day, though. They have a lot of Bitcoin. And because they're so exposed, they really want me to comfort them and convince them that Bitcoin is safe. I can't do that. I could be wrong, but I can't compare that. I think the way gold behaved in April and May compared to the way Bitcoin behaved was no coincidence. If you're looking to speculate, you have to have the stomach for it. But gold was far more anti-fragile than the NASDAQ in general, or Bitcoin in particular, in April and May. And I think it's because gold's a far more stable asset. A lot of people are upset that gold hasn't reached 2,500 because we have a perfect environment. We have inflation. We have got geopolitical risk. We have negative real rates. If ever there was the perfect time for gold to rise, it should have been now. And so they're angry that gold hasn't risen as much as it should. And we can talk about that more. But I think compared to Bitcoin and the NASDAQ, I think gold behaved much more reasonably as it should. And I think also it's important to remember to step back, look at this from the big picture. You know, just as recent as 2015, gold was trading the 1,000s. 2019, it hadn't even broken 1,300. And now we're in an 1,800 range. So I think gold actually has behaved quite stable, and it actually has appreciated consistently. The fact that it hasn't reached its August 2020 highs doesn't mean gold is disappointing. And I think gold is just stretching its legs for a much longer run. Again, a bias, but not even just because I'm at Matterhorn. Even Goldman Sachs' head of commodity research, Jeff Guthrie, at the beginning of the year said gold should hit 2,400. It's the perfect storm. To hear Goldman Sachs talk about gold, which has not been one of their favorite assets for a while, hitting 2,400 was pretty surprising. But you have to remember there was all-time high ETF purchases, all-time high central bank purchases, and all-time high purchases of physical gold at the beginning of this year. And so it's not just Matterhorn, it's even Goldman Sachs and others that see a price target of at least 2,400. We're not interested in timing the price target of gold. We look at the way it's behaving now with no surprise. I think we can talk more about gold, but I think gold, its bull market hasn't even begun.
Talk about the debt levels right now. Debt has obviously been risen just with the reaction of the governments have had with COVID. And then what is the thesis? What is the linkage with gold? And how do you see that playing out?
At the global level, at the macro level, at the 30,000-foot historical level, it's important for people to understand that every debt crisis ends terribly. And that's throughout history. From ancient Rome to today, there's no exception to Newton's apple falling or debt destroying nations. And usually a debt crisis leads to a market crisis, a financial crisis, a social crisis, and then a political crisis that typically ends with extreme centralization from either the left or the right. That is true throughout history. It's not gloom and doom. It's not sensational. It's respecting more than just asset classes. It's respecting history and math. You can't survive on a debt party forever without a hangover. That hangover is more than just a financial collapse. It's a social collapse with a political reaction. That's my biggest fear, actually, is more centralized controls. In the specifics, when you have a global debt problem of over 300 trillion, and you have GDP that's far less than 1/3 of that, that already is a very scary sign. It's boring math. People walk by that, they whistle past that debt graveyard, but 300 trillion in global debt with 1/3 GDP is an appalling, unsustainable number. In the US, you've got combined private, corporate, and public debt or government debt over 90 trillion. And again, if it takes $4 of debt to make $1 of income, that too is unsustainable. And the boring math that I learned at fancy schools in the US taught me what no one wants to talk about today. And David Hume wrote about this in 752, and von Mises wrote about this in the turn of the century is, look, when your debt to GDP goes past 100%, it's mathematically impossible to continue to grow your economy. In fact, you lose growth by as far as 1/3, as high as 1/3. So there is no way to grow our way out of this debt pile. We've already had too many martinis. We will have a hangover. We can keep drinking central bank Bloody Marys to avoid that hangover, which is what we've been doing for years, and sustain this kick the can policy of extend and pretend at our debt levels. But we're going to have a financial crisis, a currency crisis. It's inevitable. There's no way around it. And I think what's scary is people aren't seeing the basic math of that because they have the cognitive dissonance right now of just seeing or having seen risk assets, stocks and bonds going to all-time highs, feeling that the central bankers and the politicians have their back when they're being disingenuous. You can't sustain that debt level. You can't. And the only way you can keep these markets going is to monetize the treasury markets or the bond markets with money that's printed literally out of a mouse click. If it seems too good to be true, it is. It simply is. And again, the debt crisis now is simply unsustainable. And, what happened with COVID, whether you agree with COVID policies or not, or what happened with the war in the Ukraine, the beautiful thing about that is the COVID crisis, the majority of the money that was printed or created or the fiscal stimulus that went into saving Main Street went back into Wall Street. It's important to remember that in 2019, the repo markets tanked and there was a massive battle of those repo markets. There were already problems in the credit markets, dangerous problems, long before COVID. COVID comes along conveniently a year later, and it gives them a whole new bailout, bigger than the 2008 too big to fail bailout, but it came under the guise of kind of humanitarianism. Certainly a lot of things went into Main Street, but a lot of that money went back into Wall Street. So when this debt bubble implodes because it's unsustainable and there is no economic growth mathematically possible at a macro level to pay for it, I think the policymakers who put us here, which means central bankers in DC and in Brussels and in Japan, will blame this conveniently on COVID and now Putin. Again, not saying they created a crisis or they wanted this on purpose, but they'll have a perfect scapegoat because the one thing I've never seen from a central banker since Greenspan is accountability, not one. So I'm not a fan of central banks. Whether it was Thomas Jefferson or Andrew Jackson or even Woodrow Wilson, who signed the Federal Reserve into law, they all regretted the central bank. They all warned against it. It's very easy to be chest-puffing anti-central bank, but I think we're going to pay the price for the hubris of central bankers. As they say in German, Hochmut kommt vor der Fall. The arrogance comes before the fall. And I think the arrogance and the dishonesty, the disingenuousness, the drunken driving, the idea that you can solve a debt problem with more debt and then monetize that debt with a mouse click, if it seems too good to be true, it is. And it's amazing how people just don't want to see that right now. And again, that's not a gold bug bias. I grew up in the markets, out of college, out of grad school, all about risk assets, stocks, bonds, spreads, arbitrage, fancy vehicles, fancy option strategies. All that's wonderful and good. But it's like I joked the other day in an interview here in Germany, it's like being on the Titanic and discussing option strategies like you're discussing dessert choices. Is it going to be creme brulee or cake or ice cream when you're missing the dead iceberg right up the bow? So we're having all these fancy talks about ways to handle these markets and this volatility. And very successful traders who have experience with options can maybe do that. The average investor, though, is missing the debt iceberg. And none of the central bankers want to talk about it. They say, be calm, carry on. To me, there's no reason to be calm right now. This debt has consequences, social, political, financial, and markets. And gold is just one way, one of very few ways that you can kind of prepare for that. It's not about speculation or price moves in the paper price of gold, which is manipulated by the COMEX market anyway. It's just about having insurance for dying currencies. We have insurance for our homes, our cars, our lives. To me, gold is very boring. It's insurance for currencies that are dramatically debased over years and years of expanding the money supply. And so in a sense, we can talk about markets and risk and all the things we do at Matterhorn. I kind of joke to my friends, I'm just an insurance salesman. I insure currencies that have been debased. And the relative power of the dollar versus other currencies is to me irrelevant. It's the inherent purchasing power of these currencies that's the real issue. People also don't realize that since 1971, when we closed the gold window, when you compare the dollar, the euro, the yen, or other major currencies to 1 milligram of gold, all of those currencies have lost 95% of their value compared to gold. So again, gold price measured in dollars or euros or yen is irrelevant. I measure it in terms of grams and ounces. I just know that my gold is boring and unattractive and controversial as it is, and as scarce as it is, has far more trust, faith, and credibility than the dollar in my portfolio or my bank account or my wallet. Sadly, that's what years and years of drunk driving, false promising, we got your back, central bank policy has done to us, which is why from the 1700s to today, experts in economics have said, be very careful about your central bank policies. Remember, the Fed is a private entity. It's not even a federal entity. It has a fancy name. It's on Constitutional Avenue, for gosh sakes, and yet it's not even a real federal agency. These are scary things.
How do you allocate? What are some of those few things that you're talking about before, aside from gold?
Very good question. In some ways, it's not even a question of what I'd allocate to. Obviously, precious metals to a small extent, of course, as insurance. Commodities, of course, go through cycles. We saw that in 1973 with the oil crisis. We saw in 1999 in the Gulf War. We saw it in 2008, where commodities as a class greatly outperformed the S&P. And when this everything bubble has its moment of uh-oh or its hangover, just broad allocations to hard assets, of course, is a good move. I think the other important thing is not just what you invest in, it's what you don't invest in. And I, having come up in Wall Street through risk assets and risk parity portfolios of 60-40 stock bond or 70-30 stock bond, the most important advice I would give to investors is to at least avoid that. At least avoid the consensus thinking that your bonds are going to somehow hedge against your equity risks. To me, bonds and stocks, because of profligate central bank policy, because of the unnatural bond support by buying treasuries and keeping yields repressed, and by creating a bond bubble, what you have in a risk parity 60-40 stock bond portfolio, and whether those stocks are growth and value and those bonds are treasuries, junk, yield, high growth, they're all highly correlated and highly overvalued. So when and however, and no one can time the when, no one, however those bubbles pop in risk assets like stocks and bonds, they're going to go down together. They're not going to hedge each other. So bonds are not the bond market of my dad's generation or my grandfather's generation. They simply aren't. I look at hard assets in general as a much better hedge against tanking equity markets, for example. Ronnie Sturfler, our good advisor, has said, when you look at S&P crashes, gold on a median level outperforms stocks by 45%. So for me, it's not even about speculation, it's about protecting wealth. One thing I've learned from the dot-com era on is if you want to make money in the markets, don't lose 60-70%. Don't lose money. The best way to make money is not to lose it. No one can time this. I've been bearish on these central bank-driven, low interest rate-driven markets for 5 years. I still trade. I still use options. I still use these fancy strategies, but I'm extremely cautious about this false confidence that the Fed is going to save us. The only way the Fed can save these markets is to monetize them. So that's the choice we have right now. They can monetize the markets, fine, we'll have a more and more of a stock or risk asset bubble. But to do that, they have to create and expand the money supply, which kills the currency. So it's either kill the currency or save the markets. And if they try to save the markets, they will kill the currency. And I think that's an inflationary policy that makes sense. Because if I were a central banker and I was a politician, which is what a central banker is, I would print more money. I would definitely keep the inflation rate above the yield on the 10-year treasury. We'd have negative real rates. That's the oldest trick in the book. Powell and everyone is puffing their chests saying they're going to combat inflation. 75 basis points, 150 basis points, 200 basis points? That's not going to combat inflation. That's just posturing. All they want to really do, in my opinion, and everyone on Wall Street that I know who manages money says the same thing, they're going to pretend to fight inflation while they're going to deliberately seek inflation because they want inflation rates they want it to outpace yields or rates or interest rates. That's negative real rates. It's the oldest trick in the book for debt-soaked countries to get out of debt, to inflate it away. Great for the politicians who can blame all this on COVID and Putin. Horrible for the man on the street. And that's why we see so much social unrest right now. The wealth inequality, the frustration, the distrust, the massive amounts of those who have and those who don't have. The disparity is creating social problems, which we can blame on race, we can blame on politics, but it's really just when people start to feel the pain of inflation and the pain of the discounted purchasing power and the frustration of the wealth disparity. That just creates tension. So again, from the very beginning, debt crises create market crises and currency crisis, but they create social problems as well.
Matthew, thanks for speaking with Kitco.
Thank you. It's good to be here.
He's Matthew Piepenburg. He's principal at Matterhorn Asset Management. My name is Michael McCrae. You're watching Kitco Mining here at Deutsche Goldmesse here in Frankfurt, Germany.
Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Defiant Silver.